You're watching a stock chart go parabolic. The price action is practically vertical, and logic tells you this rally has to collapse. You just need the right moment to short it. So you check the most popular momentum indicator in the world, the Relative Strength Index. And right there on the chart, the RSI line crosses above the critical 70 threshold into the zone clearly marked Overbought. You have your signal. You take the short position. But look closely at what happens next. Despite the RSI screaming that the asset is overbought, the actual price just keeps climbing, right up until your account is liquidated. Taking a trade simply because an indicator crossed a static threshold is a structural trap. Blindly following this basic rule destroys thousands of amateur accounts every day. To understand why that trade failed, we have to go back to 1978. J. Wellis Wilder introduced the Relative Strength Index long before high-frequency algorithms dominated the market. He designed it as a momentum oscillator, a tool that measures the speed and magnitude of recent price changes on a fixed scale from 0 to 100, typically looking back over a rolling 14-day window. The traditional rulebook says that a reading below 30 means an asset is oversold, and a reading above 70 means it is overbought. The implication is that the market is stretched too far and a reversal is imminent. The math behind Wilder's invention is sound, but applying those rigid historical boundaries to modern aggressive trends is exactly where traders get caught off guard. This document breaks down what the RSI is doing under the hood. The core equation calculates a ratio based on recent market behavior. Specifically, it divides average gains by average losses over the look-back period, stripping away day-to-day noise to show raw momentum. Because of this structure, the RSI is inherently a contrarian indicator. It isn't designed to confirm the direction the market is currently moving. It is actively hunting for mathematical exhaustion in that momentum. And here is the critical misunderstanding. The math only tells you when momentum is historically stretched. It absolutely does not guarantee that the price is going to instantly reverse direction. Let's look back at our opening trade. In a powerful, sustained market uptrend, the price will completely override the indicator. The RSI can stay pegged above that 70 line for weeks while the asset continues to climb. If you treat that 70 line as an automatic trigger to sell or short the market, you will prematurely cut your profits and expose yourself to massive risk. Instead of waiting for a threshold, professionals look for a phenomenon known as divergence. Consider a bullish divergence. The actual price pushes down to a new low, but the RSI forms a higher low. This geometrical conflict proves selling pressure is dying internally, and momentum is exhausting itself, even if the surface price hasn't reflected it yet. Professionals don't care where the RSI line is sitting vertically on the scale. They care about where it is going relative to the actual price. But even divergence falls apart if you apply it to the wrong time frame. When you drop down to the minute-by-minute charts of a modern algorithmic day trading environment, the rules change entirely. Recent empirical models analyzing high-frequency trading show that adding traditional indicators like the RSI at these micro speeds provides zero stable advantage or predictive power. At the 1-minute level, the signals generated by the formula are completely swallowed by random market noise and algorithmic lag. Applying a mathematical tool designed in 1978 for a 14-day lookback onto a 1-minute chart is a structural failure of logic. To see the indicator actually work, you have to zoom out. When applied to longer holding periods and daily charts, the historical data tells a very different story. This graph compares predictive advantages across timeframes. A recent comparative study on the LQ45 index over a year-long period found that on a daily scale, the RSI successfully produced correct reversal signals with a 97% accuracy rate. However, because it requires the market to reach such extreme mathematical conditions to trigger, it generates very few signals. To trade safely, it has to be paired with broader trend-following tools like moving averages. The RSI is not a standalone weapon meant to fight a raging market. It is a diagnostic tool designed to measure the underlying health of a trend over time.